Alright, welcome back. Before you place a single trade on sterling today, you need to see the trap that institutional desks are setting right now. Price is hovering at 1.3437, and it looks like an easy momentum buy. But there's a daily storm hiding above, and a massive liquidity pool below. There is one danger zone and one hidden opportunity today. I'll show you both. Stay until the end. I'm giving out 3 exact entry and exit levels you can use immediately, including the aggressor play that could capture a breakout if you dared. Here's my instant market verdict for this session. The bias is a fade. That means I am fading the intraday bounce. The 1 hour and 5 hour charts are screaming strong buy and buy, but the daily chart is a solid strong sell. In my book, that is a classic bear flag setup, not the start of a new bull run. The structure is range-bound between 1.3368 and 1.3480 until proven otherwise. The one invalidation level that flips the whole script is 1.3480. Write this number down. If we get a 4-hour candle close above 1.3480, the daily sell pressure is defeated and we shift to a bullish breakout. Until then, every pop is a potential short entry. The danger zone is the cluster between 1.3458 and 1.3480. The hidden opportunity is the sweep of 1.3390 support that will trap late longs. So here's your assignment right now. Type the number 1.3480 in the comments, because that's the line in the sand today. Now let's go deep into the technicals. Top time frame down. I want you to visualize the chart as I speak. On the monthly scale, this pair is in a strong buy. That's the big picture. The weekly is also a buy. So the higher time frames have an upward drift. But here's the part most traders miss. The daily chart has flipped strong sell while the weekly is still positive. This is not a contradiction, it's a correction within a bull market, and it's the most dangerous environment for trend followers because you get whipsawed on both sides. The daily sell signal is real. The MA20 on the daily sits right at 1.3458, and it's acting like a brick wall. Every test over the last several sessions has been rejected. The MA50 is right above at 1.3469, reinforcing the ceiling. The MA100 is at 1.3452, so you have a tight cluster of 3 moving averages all within 17 pips of each other. That is resistance density you don't see every day. Underneath, the 200-day moving average is our lifeline at 1.3380. That's huge. We are currently 57 pips above it, so the daily bull structure is not dead, but it's on life support. The MA200 is aligned perfectly with the key support zone at 1.3390, making that area a magnet for stops and a technical flaw that smart money will defend. Now drop down to the 4-hour. The 4-hour chart is in recovery mode after that bounce from 1.3368. The fast Mars, the MA5 and MA10, are curling up, with the MA5 at 1.3426 and MA10 at 1.3440. The 4-hour MACD has just fired a weak bullish cross, but the histogram is barely positive. It's what I call a low energy bounce. On the 1 hour, you see the strong buy on the indicator, but RSI on the 1 hour is sitting at 47.5, completely neutral, not even overbought. That tells me there is no real conviction behind this bounce, just short covering and weak hands piling in late. Here's where the cross-asset linkage gives us the edge. Look at the dollar index. The DXY is holding firm near its own moving average cluster, and euro to US dollar is struggling at lower resistance. If the dollar isn't truly breaking down, then pound sterling to US dollar upside is capped. Sterling is just the strongest of the weak dollar antagonists today, but the king dollar hasn't been dethroned. Let's talk support and resistance explicitly. The immediate resistance is 1.3458, which is the MA20 daily and the top of the intraday channel. Above that, 1.3480 is the structural swing high that must be taken out to convert to a bull trend. Support sits at 1.3390, which is the bottom of the 4-hour range and aligns with the 200-day MA. Below that, the next major support is 1.3368, the recent swing low. A break below 1.3368 would trigger a measured move toward 1.3300, but we'll get to that in the trade setups. MACD on the daily is still negative at minus 0.001, basically hugging the zero line. This is a classic equilibrium moment, a point where the market is coiling for a directional explosion. And if you look at the negative divergence on the 1-hour momentum against the price making a higher high, you can see buyers are exhausted. This is exactly the kind of trap that forms before a sharp rejection. Now let me weave in the fundamental driver and the narrative web that makes sense of this price action. The last 24 hours gave us two conflicting headlines. Sterling remains steady, but weak business activity data weighs. And separately, we see reports that pound sterling to US dollar is recovering amid UK inflation data, with positive signals emerging. This is the confusion that algorithms are feeding on. The weak business activity data, likely the UK services and manufacturing PMI flirting with contraction, suggests the economy is cooling faster than the Bank of England wants. That should be a pound negative. But the inflation recovery headline implies that some pockets of price pressure are still sticky, which could force the bow to stay hawkish. That's why you see this weird bounce, but the momentum is shallow. The market is pricing in a policy gap between the bow and the ECB that could support GBP against EUR, and indeed euro to pound sterling has been ticking lower, which props up cable indirectly. However, when we look at the dollar antagonist fracture, the picture changes. The Federal Reserve is pushing back on rate cuts, and US yields remain elevated. That yield differential is a persistent headwind for any sustained pound sterling to US dollar rally. My 1 to 2 week directional lean is bearish, not because I dislike the pound, but because the daily trend has turned, and the fundamental mix doesn't support a breakout just yet. The one event that would invalidate this bearish thesis completely is a daily close above 1.3480 combined with a break in the DXY below its recent support. If that happens, I'll flip to neutral and look for a retest of 1.3520. But right now, the weight of evidence favors a fade. Most people will skip this next section, but this is where money is made. Keep watching. We're going into 3 specific trade setups with exact triggers, exact stops, and exact targets. But first, a retention link you can't ignore. The S&P 500 and Bitcoin divergence video is live right now. That correlation crack is something every risk asset trader needs to see. I'll drop the link at the end, but stick with me because the precision levels on sterling will give you a clean plan for the next 48 hours. Setup number 1, the sniper, conservative. This is for the trader who wants probability on their side and refuses to chase. The trigger condition. Price must rally into the 1.3458 to 1.3460 resistance zone and show a clear rejection pattern on the 15-minute chart. I want to see a bearish engulfing candle, a shooting star, or a double top with the high exactly at 1.3458. Then you execute the short. Your stop loss goes at 1.3485, exactly 7 pips above the structural resistance and the high of the expected range. That's a 27 pip risk from the 1.3458 entry. Target 1 is 1.3390, the 200-day moving average support. That's a 68 pip gain, giving you a risk reward of 1 to 2.5. Once target 1 is hit, move your stop to break even. Target 2 is 1.3368, the swing low. That's 90 pips from entry, a 1 to 3.3 reward. This setup is void if price closes a 1-hour candle above 1.3480 before you get filled. Patience is the sniper's ammunition. Don't force it. Setup number 2, the active trader, standard. You want to participate on a breakdown confirmation, not on a limit order. Here's how. Entry condition. A 1-hour candle close below 1.3420. That's below the MA5 and signals that the intraday buying pressure has evaporated. Your stop loss sits at 1.3465, just above the MA20 daily and the midpoint of the resistance cluster. Logic. If price recovers back above that level, the breakdown was false. That's a 45 pip risk. Target 1 is the same 1.3390, 30 pips away, giving you a 1 to 0.66 risk reward initially, but here's the trick. When 1.3390 is reached, you tighten the stop to 1.3430, locking in profit and giving the trade room to breathe toward 1.3368. Target 2 is 1.3368. The trailing stop rule: once target 1 is hit, move the stop to 1.3410, which is just above the next minor resistance flip level. This turns it into a free trade with asymmetric payoff. The setup fails if the 1-hour candle close below 1.3420 is immediately reversed within the next 2 hours by a closeback above 1.3440. That means the sellers are trapped. Now let's see how aligned we are. Type your pound sterling to US dollar range for tomorrow in the comments right now. Give me your high and low, like 1.3460 to 1.3380. I'm reading them, and I'll shout out the most accurate in tomorrow's video. Setup number 3, the Aggressor, high risk. This is counter-trend and for those who know how to lose small and manage risk aggressively. The idea: if the daily sellers fail to hold 1.3458 and we get a momentum breakout, you ride the surge. Entry condition: a 4-hour candle close above 1.3480 with conviction, not a wick. The confirmation is that the next 1-hour candle does not immediately reverse. You go long on a pullback to 1.3465. Stop loss sits tight at 1.3435, below the MA10 and the breakout point. That's a 30 pip risk. Target 1 is 1.3520, the next psychological and measured move level. Target 2 is 1.3560, a prior supply zone. This is a high-risk aggressive play because you're betting against the daily sell trend and the macro headwinds. Only take this if you can handle being wrong 3 times in a row and still stay disciplined. Explicit warning: this is a momentum chase. If you're not watching the screen, do not take this trade. Risk management pulse, 30 seconds. Never risk more than 1 to 2% of your account per trade. No positions through high-impact UK or US news. Stops are non-negotiable. If the price gaps through your stop, exit immediately, don't hope. Trading is a business of probabilities, not prayers. Now let's close the loop and set you up for the next 24 hours. The one most critical level for the next session is 1.3458. That's it. As long as we stay below that daily resistance, the bears own the order flow and the path of least resistance is a grind toward 1.3390 and then 1.3368. A break above 1.3480 negates the immediate bearish case, but until then, the collapse scenario is fully in play. Tomorrow's focus will be on the final UK services PMI revision and any surprise comments from both speakers, but even more importantly, the US durable goods number. That data could be the catalyst that either breaks sterling through the ceiling or sends it tumbling through the 200-day moving average. If you want the full breakdown on Bitcoin and the S&P 500 divergence, that video is live now. Check the end screen. Smash like if this analysis gave you a clear plan. Subscribe and hit the bell for daily coverage across all 8 key assets. I'm watching the same levels you are, and I'll see you in the next one.